Concept check 4.2. First is give 5 examples of income that must be reported to the Internal Revenue Service. Top of the list, wages and salaries, commissions, bonuses, tips earned, interest and investment income, retirement income. I believe that's the complete list, actually. Next, how are long and short-term capital gains treated differently for income tax purposes? The long-term gains are taxed at the lower capital gains rate, while short-term gains are taxed at your ordinary taxed as ordinary income or using your marginal tax rate. So we mentioned previously the capital gains rate can be 0, 15, or 20% depending on your income. So you can check that out on that Putnam sheet that's posted in Canvas. The next 5 examples of income that is excluded from IRS reporting: gifts, inherited money or property, life insurance benefits, child support payments, scholarships spent on required fees. 3 examples of adjustments to income: IRA contributions, alimony paid. There are new limitations under the new tax law. So be sure if you are paying alimony, look into that. Student loan interest paid. So 5 examples of tax credits: health insurance premium tax credit, American Opportunity tax credit, lifetime learning credit. I actually listed them all here: earned income tax credit, child independent care credit, child tax credit, adoption credit, mortgage interest credit, retirement savings contribution credit, elderly or disabled tax credit. So, learning objective 3 is using appropriate strategies to avoid overpayment of income taxes. A lot of people think it's a great thing to get a big tax refund. Well, but if you're doing that, you're effectively loaning money to the IRS. So you might remember there are a lot of people who were upset when they paid their 2018 taxes that they didn't get a refund. Well, the reason they didn't, they actually probably paid less in taxes in 2018, but they received more of it as income during the year because it wasn't over withheld. Anyway. So, practice tax avoidance, not tax evasion. So, you know, you can reduce income via your employer. The premium only plan refers to health insurance. The transportation reimbursement plan, certain transportation expenses are deductible if they're used for work. Flexible spending accounts. There are flexible spending accounts for both medical expenses and childcare. So if you pay for daycare, for example, you can pay for that out of a flexible spending account, and that money, the money used out of that account you will not pay taxes on it. The one thing to note about flexible spending accounts: you do need to be very careful about those. Because for some stupid reason the money goes away if you fail to use it. Defined contribution retirement plans, 401k. It would also apply to a defined benefit retirement plan if you're lucky enough to work for a company that has a defined benefit plan and you have a retired contribution. Those contributions would be tax deferred effectively. 403B or 457 plans if you work for government, public sector, so forth. Matching contributions. So any contribution provided by your employer is also tax deferred. Um, Tax shelter investments earn yields that are tax advantage, meaning they're not, if you have money in your retirement plan that's earning income, you're not going to pay taxes on that until you withdraw it. The same in an IRA as well, or traditional IRA. So so tax shelter investments, we're talking about investing with pre-tax income rather than after-tax dollars. Also, if you have a choice of you putting your money in an employer plan versus an IRA, and you're talking with regard to your current income, you're probably better off putting in an IRA because there are limitations with regard to income and deductibility on IRAs. Those are also spelled out in the Putnam sheet. Tax deferred investment growth. So that investment growth isn't taxed until you withdraw the money. One thing to note about tax sheltered investments, most of them will charge you 10% penalty with a few exceptions. If you withdraw the money before you're 59 and a half with regard to retirement accounts. And education accounts are different, but if you don't use them for eligible expenses, you would pay taxes on those. So IRA and Roth IRAs, the traditional IRA is much like your employer's retirement plan. Depending on your income, you can deduct that from your taxable income. Roth IRA is different. A Roth IRA, you invest on an after-tax basis, and all the income on that Roth IRA is exempt from taxes in the future. So both can be a good deal. It just depends on your situation as to which is the best. So, all right. So we'll continue with education accounts in the next lecture.